colorful, nice. We can even bold them a little bit in order to have better. Let's go for Ichimoku. Let's make them looking great. Okay, let's bold those. Boom. Even looks better right now, right? So many colors. So just because we have a lot of colors, a lot of curved lines, a lot of crowded chart with indicators, doesn't necessarily mean we're gonna get better, we're gonna become better trader. More indicators means worse decision taking. Less indicators it doesn't necessarily mean accurate decision taking. But more indicators that are not made strategically, that doesn't have any logic behind, can actually be only wrong. If you learned volume indicator from some trader, if you learned MACD from other trader, if you learn RSI from me, if you learn moving average somebody else talked about Ichimoku Kinki price relationship, and there is a Bollinger Band indicator that people also use a lot with standard deviations and you learn them all, but you are learning them from completely different sources, people, strategies, and you just combine all of them. That's not going to help you anyhow to become a better trader. And unfortunately, even when we play, some people are using so many indicators that they don't see their price. Price is not visible here. So it's so many indicators that price is barely visible. What it means? It means that, let's go back to the core information behind what they mean, from where they come, which one comes first, chicken or egg, or indicators or price action. What is indicator? Technical indicator, it's a mathematical formula, mathematical formula that calculates the price and gives the visual representation as result. This is it. So mathematical formula that calculates the price. So if we take out price from that, it is just mathematical formula. It's nothing else. It's just a formula, mathematical formula that needs data in order to present information. If there is no data, this mathematical formula will be useless at that point. Okay, from where the data comes? From the price movement. Okay, price goes up, down, closes, opening, high, low, right? It moves over time. And this mathematical formula takes the data from the high price, from the low price, from averages, from closing, and then it presents us some information that we needed based on that formula. That's it. This is the indicator. So what kind of formula we will need depends on our needs, right? So what would be your need? You say, I often see that the price is moving up, then goes down, then goes up, right? Like this. I actually notice price goes down, price comes down, price goes up, price comes down. You see it actually moves in some waves or some up and down. How to notice that, how to recognize that when the price peaks and that the new decline is going to come, and down at the bottom that is going to restart the trend, and where is the new peak that is coming, so I don't buy there and wait price to decline down, so I buy then. How to recognize those? Well, quite often this price have its average movement, right? Averages. So you can use some statistical measurement using some moving averages. It's not necessarily financial market related thing. It's statistical thing. It's moving averages, can be used in many different places, not only in trading and financial markets. So then you come with moving average, but which period? You test. If it's 200 period, it's far. This is not related to current market price. 100 still far. You can use 50, yeah, getting closer, You can use 30, right? Wow, that's actually taking the bottoms. 10, 20, you can check different periods of moving average, which changes the formula based on its periods. The formula is the same, just the period calculation is changing. And based on that, that indicator's shape is changing and is getting closer or more away from the price. And that potentially can give you some information because you see that there is some average price. For example, this is the median or average price, which you want to see the price going up and down. What would be standard deviation? You can check Bollinger Bands for that particular reason if you need to find dynamic support and resistance for the price while it's moving up from where the price is changing its direction. You can just follow through some logic, right? You might need to understand when exactly this peak happens and something to give you information that there is a potential peak. So what the price is doing here, rising with fast speed, impulsive rising. It's strong market. Buyers are strong. It's strengthening here. So I'd like to see this instrument strength, relative strength, which means this relative to the previous move. Okay, so price, the previous move was like this, right? And it's coming down. So I want to see this relative to the previous move. So what is going to happen? How I can recognize it? You go for the relative strength index, and it's going to calculate the recent impulse, will compare it to the previous impulse. And relative to the previous impulse, this impulse is weak. And it goes for higher high, but the RSI is actually coming back to 70, and it doesn't confirm that it's a really strong bullish trend. Your price action trend may look bullish, but the RSI stays, I don't trust it. It's way weaker than before. So the bulls behind are not so high quality. So this is food for thinking. You say, okay, this mathematics says that the latest move it's not as strong, but my eyes are saying that it's strong because it makes higher high. But which is right, mathematics or me? Well, both can be right, but at that point, mathematics says that current move is weaker than the previous one. So that could be the point of reversal or so-called peak where the price can start sliding. Okay, so we find out from the relative strength, from the CCI, from stochastic, from many other, from MACD that are helping us to recognize those potential peaks. But how long this can decline down? Okay, relative to the previous move, you can see on average 50 level of testing, or MACD comes to the zero line, let's say, and then starts rising again, or dynamic moving average, which is average price that they say sooner or later the price is coming to test its averages. But which averages? Well, which averages is based on the current behavior. So historically, the price was testing different averages, but right now it seems like respecting 30. Historically was respecting 21, now it's 30. So we need to adapt also our formula, our visual representation, so see how deep the price is correcting. So then use that. When later on, after a time, price does not stops respecting 30, changes its behavior and starts being more aggressive and stronger, it would respect only 10 or 20, right? Or if it comes with deeper correction to 50, it can stay like this. So you need to, your job is to track the market behavior and adapt to that. So respecting 30 and the relative strength says it's peaked, price comes down to 30 and the relative strength shows strength. There is hidden divergence. There is a great bullish price action buy signal. It's amazing to follow the trend. So yes, indicators, using them logically, they can help a lot, but they cannot be the core and main trading tool principle because price comes first. If we cannot study the price, then okay, we can use mathematics, statistics, and indicators, fine. It's better to rely on some data rather than not. But if you study the price, which helps you to understand the market behavior based on that, wow, it's going to be even way better. So price action, it's the study of price behavior. That's it. How we study the price behavior? Back testing and forward study. Back study is just to come back and see historical prices by going naked chart, only price and you, not nobody else, no indicators and nothing. You come here, you study the price behavior. Every time this big candlestick formation happens, price changes its direction. Is that true? You go and check. Boom. You go and you check. Boom. Every time there is such a candle, the price goes and drops. Well, this manual style of testing, studying the price behavior, can help a lot, but at the same time, we can track ourselves by backtesting. It's also very dangerous. Why? Because I know about shooting star and bearish pin bars, and when I go back on time, I see that I know that shooting stars and pin bars are changing the direction of the trend when they are at the top, okay? And I'm looking only the tops. I'm looking to see reversals on the tops, okay? And then I am missing the ones that are not so visible because they didn't change historically the trend. You see, bang, this was perfect shooting star, but it didn't change the trend. It failed. So if you go back in time and testing shooting stars only and only check the peaks, we're going to see the best shooting stars. But we will miss amazing looking shooting stars that are not changing the trend. So that's why there is a theory in candlesticks method. It's every time when there is a reversal pattern, every time when there is a trend reversal, there is reversal candlestick formation. But not every time when there is a reversal candlestick formation, the trend reverses. So look, price reversed every time. Look, inside bar, bearish breakout, shooting star, bearish engulfing, shooting star, inside bar breakout, shooting star, bearish pin bar, bearish engulfing, bearish inside bar, fakey setup, or bearish pin bar, price declining. Bullish gap close or bullish gap close, price changes its direction. Inside bar breakout, price changes its direction. Every time when there is a changing direction, every time there is a reversal. Piercing pattern, bullish engulfing, big rejection. This is not changing direction, like hammer bullish engulfing, right? There is every time candlestick reversal, but not every time when there is a candlestick reversal, the trend changes, okay? Not every time when there's bearish engulfing, the trend changes, right? So price study is very important, and you can trade only by using classic price action, studying candlesticks, studying trend, market behavior, higher highs, higher lows, chart patterns, accumulation, distribution phases, markup, markdown, Elliott waves, and all type of different price study to understand the market behavior so you can recognize the changes on the market so you can join that. It's amazing, but it takes time. The same applies for indicators. There are endless amount of indicators that we can study, but we can break it down, those indicators, into a couple of categories. We're going to use them this session. We're going to analyze and we're going to open positions later on, second half of this session, by using indicators and price action. We're going to go through US indices, gold, Forex, whatever you are interested in. So technical indicators are also in different categories. They have trend followers, trend following indicators, and momentum indicators, or lagging and leading. Lagging indicators are most of, if not all, type of moving averages, trend following indicators, because they are lagging behind the price. Price goes up, then they calculate the historical data and they change based on the that price. So for 10 period, we will need new 10 candlesticks. So the more price moves, the price just follow, the indicator just follows behind this price. Leading indicator are mostly looking at the price momentum. If momentum fades, leading indicator immediately catches it, immediately gives signal, immediately says something is going on here. If behavior of the market changes, if the trend is weakening, it says trend is weakening. If momentum fades, says momentum fade. If there is a divergence between the price highs and lows with the indicator, this would mean that there could be a fake higher high. It's not real fake, it's just the way that market behaves. but the indicator says the real high is lower than the previous one because the strength is weaker. Current price strength is way weaker than the previous one. For example, this is one bearish divergence. So